Here's a summary of Nu Holdings 2026 Q1 earnings call transcript, focusing on key financial metrics, management's outlook, risks, and important statements from the CEO and CFO. Introduction and financial framework. The call began with an introduction to Nu Holdings 2026 Q1 results. A key point of clarification was the use of a managerial P&L framework for internal management, distinct from IFRS, with a reconciliation provided for investors. All growth rates discussed are on an FX-neutral year-over-year basis. Key financial metrics and performance. Revenue reached a record $5 billion, a significant milestone driven by customer growth and expanding average revenue per customer, ARPAC, which now stands at approximately $16 per active customer. Profit achieved a historical high net income of $871 million for the first quarter, representing over 80% year-over-year growth on an FX-neutral basis. Gross margin, implied by gross profit reached $1.88 billion, up 27% year-over-year on an FX-neutral basis. The CEO highlighted a trend of diversification, with credit, float, and fee businesses balancing each other, leading to a higher quality earnings profile. Efficiency ratio. A record low efficiency ratio below 18% was reported, with the core ratio, excluding specific investments, at 16.6%. This was attributed to strong revenue growth and operating expense discipline, including AI-driven improvements. Credit portfolio. The consolidated credit portfolio grew to $37.2 billion, up 40% year-over-year FX neutral, with strong growth across credit cards and unsecured lending. Deposits. Total deposits reached $42.4 billion, up 22% year-over-year FX neutral. Some seasonal deposit outflows were noted, particularly in Mexico, linked to optimizing cost of funds. Cost of deposits closed at 88% of the interbank rate, with sequential improvements in Mexico and Colombia offset by Brazil. Net interest income. A record $3.25 billion was reported, up 12% quarter-over-quarter FX neutral, driven by portfolio expansion outpacing liabilities. Net interest margin, NIM, reached 21.1%. Credit loss allowance, CLA, increased by 33% quarter-over-quarter FX neutral to $1.79 billion, primarily due to seasonality, portfolio growth, and a shift in portfolio mix towards higher loss products. Risk-adjusted NIM contracted sequentially to 9.5% from 10.5%, largely due to the elevated CLA. Management expects this to normalize back towards H2 2025 levels. Coverage ratio. Total coverage stands at 16.2% of the portfolio. Management's forecasts and future outlook. Full year 2026 efficiency ratio expected to converge towards approximately 20%, consistent with 2025 levels, including strategic investments in return to office, U.S. expansion, and AI infrastructure. IFRS effective tax rate, ETR, for the remainder of 2026, expected to converge towards the 15% to 20% range. Managerial ETR, expected to converge towards the 30% to 35% range. Mexico. The company is seeing its earnings-generating formula unfold earlier than anticipated in Mexico, reaching IFRS profitability ahead of plan. AI transformation. This is a core priority, focusing on rebuilding banking around AI, with phases including AI assistance, largely complete, workflow reinvention, in motion, and the AI-native bank, early stages. U.S. expansion, being pursued deliberately and at a measured pace as a call option. The maximum expected OPEX headwind for 2026 and 2027 is less than 100 basis points on the consolidated efficiency ratio, with further investment contingent on product market fit. SME business in Brazil, seen as an underappreciated opportunity, with a silent build of the largest SME base in Brazil through cross-selling. Ambitious plans are in place for this segment. Secured lending, expecting continued growth, with a pickup in public and private payroll loan originations to offset FGTS headwinds. Significant risk factors, credit quality. While management emphasized no signs of asset quality degradation, the increase in CLA was driven by seasonality, portfolio growth, and a mix shift towards higher-risk products. Investors continue to monitor this closely, especially concerning the lower-income segment exposure. International expansion challenges. The U.S. market presents a significant challenge with competent competitors, and success is not guaranteed. AI disruption risk. From investor perspective, some investors are reportedly concerned about the disruption potential of AI, particularly in the context of U.S. market entry, as they haven't seen a digital bank succeed at scale there. Seasonality. Typical first quarter seasonality impacts activity rates and credit provisions. Competition. Competitors are also focusing on secured loans and private payroll, areas where Nu is strategically pacing its rollout. Highlights. Record revenue and net income, demonstrating strong top-line growth and profitability. Customer base expansion, surpassing 135 million customers globally, with significant milestones in Brazil and Mexico. Operational leverage, achieved a record low efficiency ratio, showcasing cost discipline and scalability. AI transformation, significant progress in integrating AI across operations, leading to productivity gains and accelerated product development. Mexico's profitability, reaching IFRS profitability ahead of schedule. SME opportunity, quietly building a leading position in the underserved SME market in Brazil. Resilient credit portfolio. Management strongly asserts that credit metrics reflect deliberate strategy, not degradation. Diversified gross profit, a balanced contribution from credit, float, and fee businesses. U.S. expansion strategy, a carefully managed, low-risk entry with significant upside potential. Lowlights. Sequential risk-adjusted NIM contraction, driven by increased credit loss provisions due to seasonality and portfolio mix. Deposit outflows in Mexico, linked to seasonal reversal and cost optimization efforts. Pacing of private payroll loans, deliberate slowdown due to operational complexities and observed first payment defaults. Most important statements from CEO David Velez. Earnings formula emphasize the consistent formula of a growing, engaged customer base, monetized at higher ARPAC on a scalable, low-cost platform, translating into outsized earnings. Brazil and Mexico as, day one, despite current scale, viewed Brazil and especially Mexico as having vast remaining potential in their respective profit pools. AI as a rebuilding block, stated that Nu is not just adding AI to banking but rebuilding banking around AI, drawing a parallel to building a bank without branches. U.S. expansion as a call option, described the U.S. strategy as a deliberate, measured approach with bounded downside and uncapped upside, not jeopardizing core Latin American operations. Consumer obsession, highlighted the ability to build relationships with fans, not just customers, creating a strong brand. Most important statements from CFO Guilherme Lego. Credit provisions explained, detailed the three drivers of increased CLA, seasonality, growth, mix, and emphasized that these do not indicate asset quality degradation, but rather reflect a deliberate scaling of the credit portfolio and robust provisioning practices. Risk-adjusted NIM normalization, expressed confidence that risk-adjusted NIM will revert to H2 2025 levels as Q1 seasonality subsides. Efficiency ratio guidance, reaffirmed the target of approximately 20% for the full year 2026, acknowledging ongoing strategic investments. ETR structure, explained the Q1 IFRS ETR as a recurring structural feature rather than a one-off, providing guidance for the remainder of the year. Balance sheet resilience. Stress the robustness of the balance sheet, with ample coverage and provisions running ahead of new NPL formation. Private payroll data advantage. Highlighted how private payroll offerings can unlock richer data insights historically unavailable to a retail bank, enabling better customer acquisition and underwriting. This summary aims to provide a comprehensive yet concise overview of Nu Holdings 2026 Q1 earnings call.